Kunal, not all that bad. Definitely a little bit of an encouraging start. A, whether it's going to stay, and B, what trades are you punching in?
Well, I think it's a good start for the index because I think if I'm not wrong on the daily basis or on the daily charts, we've managed to come back above the 50-day moving average for the Nifty. This could be a good sign for the index that it's trying to claw back above the 50-day moving average, which has been a trend setter of sorts for the index. So we'll have to wait out for whether the index sustains or not above those levels by the end of the day. Also, I think in terms of the opening trade, Voltas is something which looks attractive at 846.47, where the stock closed yesterday. It looks attractive for a strong breakout from a bullish flag pattern. So that's a stock which I would be recommending clients.
Right. Naresh, what are the first trades that you're executing?
So continue like LIC housing, expecting eventually a breakout of 440, adding at current levels and look to add more above 435 levels.
Nilesh, Managing Director and CEO of Kotak AMC joins us now. Let's connect with him to understand that what is driving the market and bulls are back. Are they here to stay? Nilesh bhai, I used to think that we are the only two bulls in the town. But when I look around, everybody suddenly is the India bull. Everybody is excited with what's happening in the mid-cap space, small-cap space and the SME space. Now, for the sake of turning bearish, do you think one should turn bearish or one should stay with the market?
I think if you're long-term investor, you can stay bullish. If you are a trader, especially in micro caps, mini caps and small caps, this is time to be cautious.
Be cautious because whatever could go wrong has gone wrong, and whatever and the way the economy flows, the global macro setup, earnings are moving, everything is quite favorable. So why should one turn cautious or even bearish?
So market discounts all potential news and expected turn of events in the future. Undoubtedly, Nikunj bhai, as you mentioned, our growth story is looking good. But when small cap starts trading at a premium to large cap, when micro caps and mini cap starts trading at a premium to large cap, then there is a need to be a little bit cautious. Many of the micro caps and mini caps are today trading at valuation which looks excessive. They are trading there because there is a limited floating stock. There is a herd mentality in buying what moves. And maybe distribution is already happening. There is no harm in being cautious when making money is so easy.
Let's look at the factors which are at play. One is flows, second is the earnings trajectory, and third is underlying valuations. How much role do you think flows will play for next couple of quarters or couple of months?
So Nikunj bhai, today we have Triveni Sangam of flows, sentiment and fundamentals. On the flow side, retail, HNI, domestic institutional investors and foreign portfolio investors all want to buy on correction for sure. And most are also buying at current level. On sentiment side, there is Birbal ki kahani happening in India. Our line was bigger, but other lines below us have become smaller. Russia scored a self-goal with Ukraine invasion. China is scoring a self-goal by their crackdown on entrepreneurs and property sector bubble. South Africa, Brazil, Turkey, Taiwan, they all have their own challenges. In the process, their story has become shorter. Our line looks bigger. And more importantly, there is fundamental also. This is not like 2000 when there was lack of fundamentals. Today, earnings are pacing with the market. There is reasonable expectation that this year and next year earnings could be in low double digits. So when you get this kind of Triveni Sangam, undoubtedly markets are likely to trade at a little premium to its historical average valuations. My feeling is that for markets to sustain from current level will require all the three Triveni Sangam, flows should be good, sentiment should remain positive, and fundamentals should match with the prices.
Let's talk about some of the buzzing spaces, and the one buzzing one off late has been China, right? With all the stimulus moves that the government is undertaking, the impact of that, I guess, is also being felt on what's happening within the chemical sector back home. Of course, that trigger aside, soda ash prices have risen. There is talk about prices of several basic chemicals rising amid the rising crude prices, as well as the China impact. Wanted to understand what could be the beneficiaries of the China stimulus?
So number one, we'll have to still figure out what kind of stimulus comes, in what sector, and in how much form. Today, what we are seeing is resetting of Chinese economy from investment-led to consumption-led. To some extent, there is problem of capacity. And to some extent, there is excess savings, which is restricting consumption. We believe global metal and commodities will remain subdued as Chinese demand, despite stimulus, will continue to remain soft. There is a real case of dumping by Chinese manufacturers as they won't find local appetite for their product. Sectors like chemical and metals will continue to face headwinds from Chinese dumping, and government action on imposing import duty or anti-dumping duty on Chinese product will be critical for some of these sectors. I think it is too early to take a call on what China will do. They have multiple challenges and they may deliver differential kind of steps. In chemical sector per se, we believe this is time for accumulation. You don't have to buy everything today. There will be 3 to 6 months window to accumulate in chemical sector.
Nilesh, hi, morning. Wanted to also understand how exactly you're looking at playing the compounding theme within the entire financial space.
In the financial space, this is party time. NPAs are low, margins are nearly all-time high level, profitability is all-time high level, credit growth is reasonable. Even on that base of credit growth, it doesn't look like that NPA pressure will build up. Liquidity has been decent, deposit growth has been good. Essentially, for the banking and financial services sector, this is probably one of the best times. However, if you notice, the banking stocks haven't delivered as much as the fundamentals warranted. There has been little bit of derating in the valuation of banking stock. We believe from here onwards, we'll have to pick up those banks where credit culture continues to remain robust. We have seen a couple of quarters of very, very low NPAs that should not result into complacency. We should also be focusing on those banks which are leveraging technology to reduce the cost of intermediation. With this kind of high margins, undoubtedly there will be pressure to lower the lending rates or lower the margin. And banks and financial services, which will be able to reduce the cost of intermediation through use of technology, they should be probably the winner over the next cycle.
There is a block deal in Spandana Spurti where Padmaja Reddy has sold over 30 lakh shares. Now, what is the significance of this? Well, Padmaja Reddy, when she was running Sampada Spurti, there was a change of the guard because of pressure by private equity investors. She has openly indicated or publicly indicated that she would be selling in the open market. And her stake sale has been the irritant for the minority shareholders because you know that there's a large supply which is coming. I don't know what would be the residual holding after this. I'll have to do the numbers. I think Ajay is going to come and perhaps share more details on this one. But from a market standpoint, in terms of near-term technicals, demand versus supply, I think this really would be important. Nilesh bhai, we've historically discussed two sectors where Kotak AMC has been bullish in the past. One was pharma, and second was to a large extent cement. For pharma, the comeback has been somewhat unreal. From it is a sector where it is more volatile than predicting commodity prices or even predicting Bitcoin prices now, right? COVID, the peak prices, there was a peak euphoria. Then a shortage happened. Then excesses happened. Now again, shortage has started. Folks who track pharma, they tell me there's a shortage of medicine in America. 6 months ago, they told me there are excess medicines in America. So predicting pharma is like predicting Bitcoin, which is impossible.
So in a lighter vein, Nikunj bhai, they have excesses of those medicines which they don't require, like the opioids. And there is a shortage of those medicines, like manufactured by India, which is what they have not been buying at right prices. Surprisingly, in America, the entire pharma distribution is controlled by 3 or 4 players. They extract heavy pound of flesh from the manufacturer, and which resulted into derating of pharma sector along with stocks coming down. Now, Indian manufacturers and other players globally are giving it back to the distributors. There is equilibrium coming between distributor and manufacturer in US generic space. And on top of it, they are realizing that they are short of life-saving medicines. Put together, we are seeing higher volume and better margin for pharma sector. And most importantly, valuations were very low with very, very low expectations. In the market, when expectations are low and delivery is better, under promise and over deliver, undoubtedly prices move. The same thing is happening in cement. There was a patch of subdued growth. Now volumes have picked up. Margins are stabilizing. While there is some amount of cost pressure, still the results should be good. With government executing infrastructure projects at a much faster pace ahead of election, we believe cement demand will remain robust, and with reasonable certainty on margin, that sector should outperform the market.
Nilesh, always a pleasure chatting with you. Thank you so much for taking the time out.
Thank you.
Well, much better start for the trading day today. A lot of stocks which are looking lively. Let's just refresh our screens and address some of those. The Nifty, of course, is back at that 19,400 print. But chemicals, that's one space where you can't really take your eyes off from that sector, right? What a move coming in equity markets across the board. So let's try and understand a little bit more about what's really aiding the move on the chemical space and whether this is a short-term phenomena or is the sector now bottoming out. And are we going to see heydays to last for a while? Who better than R. Mukundan, the MD and CEO at Tata Chemicals, joining in on the show right now to help us understand the ongoings of the sector and, of course, Tata Chemicals in specific as well. Mr. Mukundan, great to have you today on ET Now. Morning, firstly. China soda ash prices have moved up month on month, but what we understand is they're still far away from the year-on-year prices. Is that majorly owing to maintenance shutdowns in China, pass-through of high input costs, or is it an expected recovery in China's demand on the back of stimulus measures that's aiding the move?
So I think you hit the nail on the head, because I think with the way you mentioned it, I think there has been a bit of a covering of shortages, because many people did postpone purchases, the stock levels had come down, and the new supply hasn't come on stream that smoothly as one would have expected. So that has led to a short-term issue on the ground, and the spot prices have spiked up. But we do believe that the model which we use for our own analysis is more or less on track. Maybe it was off by 6 months or 8 months, but it's on track. Where we are not able to sort of fully pin down the model, which we use internally for our own analysis, is the China demand post-reopening. I think that is still not very clear, whether it is the stimulus is working or not working. It's very early days. So I would certainly say that we have to wait for more data to come in. This is a spot market move. This is really not, we usually contract on a quarterly and annual basis. So we have nothing on the ground to say that the situation is going to become extremely tight. I still would say that if at all, it will first move to a balanced situation.
So what we want to understand, Mr. Mukundan, is this a linear trend or are we going to see a volatility in prices anytime?
See, volatility, we have to live with it, Aisha. I think there's no doubt in my mind. I think a linear trend, of course, is that as India grows from 3.5 trillion to maybe 7-8 trillion or whatever, I think we'll need almost twice as much of this material as we have today. China, while people can say something about slowing China, but even at 3%, their economy is 5 times our size today. So it is growing. They're adding to the GDP much more than what we are adding. So it is not a small number by any means. So, and also on per capita basis, when you look at it, whatever one may say, at the end of the day, I think they've got a large headroom to cover, even to get to something like $30,000 of, let's say, per capita income and those sort of income levels which we've seen worldwide. So I think this runway is there for long. I think what we need to play out is those chemicals and those inputs which are very high on sustainability, very high on what we would call, if you're located in the right place where the rebalancing of supply chain is happening. And lastly, I think we have to make sure that we are able to line up and become more efficient using all the digital and AI tools. I think that leaving that aside, we cannot predict the short-term move. In the long term, our view is that the demand is going to increase to almost 80 million tons, and there's about 4-5 million tons coming in capacity. We need to bring more capacities on stream, and we will continue to maintain a very balanced approach to this market because customers need the material, and we need to bring that on stream. That's it.
My next question is, if you take out the China equation and look at India independently, what is happening? Because soda ash is one commodity which rarely gets imported to India because of the nature of soda ash, and there are restrictive entry barriers. How is the India demand moving?
See, India demand has been robust. There is no doubt about it. But India also is, India today imports almost 1 million ton, Nikunj. I think so. And India capacities are not coming on stream as we would have liked. Because of the nature of this kind of business, it's a process which takes 3-4 years to bring capacities on stream. So we will continue to be dependent on imports for a long time to come. And clearly the sources of imports are going to be US and other places around the world. And which is why we invested long time back in US, because our view is that in a business like this, you need to be at the least cost to serve the market. And I think we are adding capacity in India, but at the same time, I think we will be adding capacity in US, capacity in Kenya. These are 3 places where we are adding to serve the market. And the growing markets are all in Asia and Africa.
That should be the mainstay for Tata Chemicals, because that's the introduction of Tata Chemicals has been, track the Tata Chemical trajectory by tracking soda chemicals. But I'm sure there's much more.
Certainly, I think we certainly have, our approach was to also balance the portfolio by building a specialty portfolio, rather beyond the basic chemistry, and the move to acquire Rallis and also to increase our stake in Rallis has been on that premise. And you will certainly see in that space, using that vehicle, some of the moves happening in terms of strengthening the portfolio and building on the portfolio. We certainly made two bets which were coming out of our lab in the area of nutrition, and another one in the area of silica and rubber chemicals. And what has happened is the rubber chemicals and tire chemicals is played out positively. And we are taking a longer time to build our prebiotics portfolio, which has been fundamentally taking longer than what we would have anticipated. So, and when you start these sort of businesses, it's not that all the bets move exactly the way you want, but we are happy that at least one of them has. And our aim over a period of time, we were about 40% contribution coming from soda ash before we divested fertilizer, and we also demerged the consumer business. We need to get there in a 5-6 year time frame, and that's the plan.
Mr. Morning, but I think what the street also wants to know a little bit more when it comes to Rallis is what was the rationale to really up the stake, given the fact that as of now the financials haven't been all that great. Is there some sort of a turnaround in the overall financial metrics, and what exactly the reason was?
I think it's just we bought stake up to the level permissible by the stock market, by the regulator, which is about just below 5%. And I think the rationale remains the same as exactly as we had held before. And the idea is to build a very strong specialty engine for Tata Chemicals, and Rallis offers that platform within the Tata Group. And we've had to sort of fix some of the issues on the ground, especially with the seed business. But I think that is behind us more or less. And with respect to the basic chemistry businesses inside Rallis, I think you would see more and more news flow coming in that direction. I don't want to be getting ahead of the team there. I think it is best that the team announces and walks you through. But we are on a path to sort of build a robust business in AgChem, but also we are looking at chemistries beyond AgChem there.
When will the real breakthrough in Tata Chemicals' journey to crack the battery synthesis will happen? I'm hoping, I'm waiting, and everybody is curious.
So that is one chemistry, Nikunj, which we work in the lab. But if you say that are we going to be a vendor of choice for the battery company, which the group has promoted, we will engage with them. But it will be based on our ability to serve them and economics which we present to our board. So I would say it is an opportunity. Sustainability presents itself as an opportunity for us. And there are 3-4 vectors here. If you look at it, we did set up a unit on biofuels, which we found was fairly difficult for us to sort of scale up given the Indian environment at that time. But it's with the environment changing now, it remains an opportunity. The battery remains an opportunity, and energy transition will remain an opportunity on the table. So, but if you say that is it something which you are including in your span of plans which are firmed up, I think it will always remain a point which we will engage. But the plan of our sphere of influence extends in basic chemistry and specialty, which I highlighted already.
I appreciate the spirit of my next question. Now, if I look at the Tata Group per se, there have been transformational changes and there have been incremental changes. For Tata Chemicals, the changes in the last couple of years have been impressive. Portfolio readjustment has happened, but that's incremental. Next 2-3 years, is Tata Chemical on the curve of some transformational changes? It will be a chemical company because of the nature of the business it represents, but there would be very different synthesis in terms of the product, chemistry, product orientation, and the basic whole approach. I mean, will it move away from being a old economy chemical company to a new energy chemical company?
Yeah, so Nikunj, I think we have to sort of say that we will add to our quiver of products, which will be new. But are we thinking in terms of saying that what has served us well for 75 years is no longer relevant for the marketplace? That'd be wrong to say. So we would continue to build strength where we have scale, and also build new businesses which will help us to sort of reshape the portfolio of businesses we are. And certainly our attempt always has been to bring exciting chemistries to the table, offer our customers choice. We'll continue to engage with that. The visibility of that, I agree with you, needs to come to front. And it is a time-consuming process. We probably shed businesses almost, we were 16,000 crore 9 years ago, I think. And we are back to that same level after having shed the business and rebuilding ourselves into a shape where we can now sort of engage in these conversations. But it's a conversation we are happy to engage in.
I just want to get this on record, Mr. Mukundan. The agreement that was signed between the Tata Group subsidiary company, that's Agritas Energy Storage, and the Gujarat government for setting up India's first gigafactory for lithium-ion batteries. Would you have a role to play in this, and a significant one?
No, that's a separate company. I think we will be, if at all, we can be a vendor to them, and we will engage with them as a vendor and supplier, just as we are to Tata Consumer. So we are a B2B company. We are suppliers of choice for companies to whom we can offer solutions, and they would work with us provided we have right offers to offer them, and it's an opportunity which we intend to engage in. Whether it comes to fruition depends on a lot of elements which we have to bring to fore and bring to their satisfaction.
Given that customers' contracts are renewed every 3 months, with prices now reviving, are you looking to revise the contract pricing?
It's too early to say. I said this is spot price. I just think that the market. I know what you did mention. We need to sort of sit back and reflect not on this, let's say, short-term volatility which goes from time to time, but what is the real demand and real supply equation. Supply, we are more or less clear. I think it's a demand situation, and demand situation, let me just say that around the world has been okay. In fact, in Europe, it's been surprisingly positive, but the Chinese demand is something which we are a little concerned. And I made that point even at the time of results that it may be 12 to 18 months, but if it's shorter, it's good for us. But I think we have braced ourselves internally planning for 12 to 18 months of ride in terms of when the demand actually stabilizes within China.
Fair enough. You had a presence in the B2C segment, and that consumer business in a sense is now part of Tata Consumer. That is what was called as the natural migration. But is this also would you always be a B2B company, or somewhere you are looking at creating new categories for B2C also?
Really, I think, Nikunj, our DNA is B2B right now. And if you say that, do you have any vector or internal strength? I think our vectors are fundamentally around our knowledge of chemistry, our knowledge of working with customers who are businesses and providing them solution. Of course, they will engage with their consumers. So we need to understand their consumer need. But I think we will always work with them to make them more successful.
Tata Chemicals today, we define Tata Chemicals as part of Tata Group, a chemical company. If I introduce Tata Chemicals today to our viewers, and when we talk about Tata Chemicals, that's how we define the company. Just hear me out. It's part of a Tata Group. It's into soda ash. It is the majority owner of Rallis. It is trying out a lot of chemistry stroke synthesis process which haven't seen a big breakthrough. This is 2023. 2026, if you have to introduce Tata Chemicals to us, how would you introduce this?
I think we'll still be part of the group, but we would have started to make forays into one or two exciting areas of the chemistries, and at the same time continue to hold our strength in the core areas which has brought us to this level.
What are you doing to reduce the cyclicality of the chemical business? Because the cyclicality in soda ash, the cyclicality in the chemical cycle is something which is real.
Nikunj, that's a good question. One of the things we've done is in basic chemistry, scale is important. So what we've done is we've actually extended our business geographically to ensure that we are not tied to one geography in terms of impact. So that has certainly brought down the cyclicality overall. But I think now we need to, having exited fertilizer, which was very large weighted in terms of revenue for us, I think we need to build a business which is equally in size of almost 6,000-7,000 crores. And I think out of that, Rallis does fill a gap of about 2,500. We still have a gap of about 3,500 or 4,000 crores, which we haven't built. It's a work in progress, and I think we need to build that.
Final question. This is more like a big picture question, perhaps about chemicals. Now, historically, I've seen that chemicals as a cycle. It always moves together. So it could be soda ash, it could be potassium, everything actually moves together as a cycle, whether it is specialized or bulk. Now that the turn has started, it started with specialized chemicals, then it started with bulk chemicals. Do you see the cycle per se sustaining for another year for across the board chemical as a category?
See, you're wanting me to tell about what is another year, but certainly I think if you look at, does the world need more of these chemicals which are more benign, more green, more sustainable? Yes. And if a chemistry has a role to play in that, certainly I think world needs more of it as we move forward, especially demand in Asia and Africa will continue to drive the growth. And there's going to be relocation of capacities from Europe and other parts of the world into this region. And India has a very significant role to play. So it's a very big, it's an opportunity. And I think it's a big opportunity. I think hopefully most of the industry will make a success of that opportunity.
Mr. Mukundan, great to have you today on ET Now, and thank you so much for giving us the color on what's really going on with the sector and, of course, Tata Chemicals specifically too.
Thank you.
Okay, that's Tata Chemicals. Let's just revisit what that stock price is up to. Still holding up 1% higher, and this is a follow-through from what you've seen pretty much all through this week. Not just Tata Chemicals, but the entire chemical sector is a buzz, and it seems like it's going to be so for a while to come. Let's now shift focus and let's talk banks. And Federal Bank is the one which is in focus right now. Let's try and understand what are the ongoings right now. What's the deposit growth quantum that they are clocking? How is it that they're mapping the downside risk to their NIMs? They're weighing a stake sale in FedFina. Let's gather all that info. We have with us Harsh Duggar, the ED at Federal Bank, joining in on the show right now. Harsh, hi, morning. Good to have you on the show. I want to first talk about the fact that you've raised funds from the IFC. Help us understand whether this gives you a reasonable runway into growth into FY24.
Good morning. Hi, thanks. Yeah, we have raised earlier. This is the second round which we are going ahead with. The first one, we had raised the money about 1.5 years back. Subsequent to that, we also raised money of about 3,040 crores by way of QIP, which was in July end. And another IFC has evinced interest in investing another 958 crores. So they have given the approval. We are waiting regulatory approvals for that part. This entire amount of 3,000 plus 1,000 of IFC, total 4,000 odd crores, is something which will be towards completely growth capital.
Your capital adequacy ratio is strong. Your ratios are impressive enough. You really don't need capital if you have to even maintain the current growth rate. So why have you tapped for more capital? Is this an indication that you would be growing aggressively, or is this just safety capital you've acquired?
A mix of both. We definitely are looking at a growth of about 18 to 20%, which is what we have been guiding the markets for. We see substantial opportunities both in the retail and the wholesale space. The outlook is good in the banking sector. If you look at the rural demand and the urban, both sides are fairly strong. So we would like to leverage on that part. And hence, a large amount of the money, which is definitely going to be towards growth capital. Yes, a safety buffer is something which is always advisable because the regulator has also been guiding banks to have buffer capital for any eventualities as well. But it's largely growth capital.
My next question perhaps is on the liability side. There has been a war to acquire more liability. Every morning I get up, I see an ad which says, come to us, we'll give you better rates than your current bank. There is a war of liabilities. How are you managing it? Because you're right there in the middle, not in the top league, not at the bottom of the pyramid, somewhere in the middle. You cannot give very high cost to acquire liability, but you will have to focus on liability. How are you managing this pull and push equation?
Liability growth, there are two parts to it. One is the fixed deposit, which we incur a cost to it. The other is the CASA piece. The fixed deposit obviously comes at a price. So that's any bank for that matter. We have a reasonably large franchise of 1,370 odd branches. Apart from that, our digital onboarding is very strong. And third, we have enough and more partnerships. So these three things are helping us out a lot. Two things over here. One is in terms of deposits. Very frankly, if you were to raise rates, getting deposits is not an issue. So what we are focusing on is ensuring that the cost of deposits is also managed. So for that, we're focusing on not being at the higher end of the rate curve and managing deposits just to fund the growth in the advances piece. That's one. Second, the 4,000 crores which we are raising, 3,000 which has already come and 1,000 is expected, is also going to help us in terms of funding our growth plan. So that's the two parts of it. Most importantly, what we are looking at is the CASA piece. And more particularly within the CASA, the current account piece, because that's virtually at no cost. And that's something we are at 32% in terms of a CASA share. We're looking to up it, which will help us not just only garner deposits, but also keep our cost of funds low.
What about FedFina though? Is the IPO planned for this year?
Yes, very much. It's in the public domain. We filed for the IPO. So we're expecting to do this in this financial year itself.
What is the outlook as well when it comes to your deposit growth? Given that Q1 has been fairly strong for the company, do you think that you can hold up this kind of deposit growth?
Most certainly, yes. I mean, we have demonstrated growth. We have a very robust liability franchise. We have an extremely granular and retail franchise base, which is what enables us to keep it low cost as well. We have been expanding our branches. This year, we're looking at adding about 75 odd branches. Last year, we had added branches. So one, between increase of the branches. The second is in terms of our digital partnerships. They're looking to, and our fintech partnerships, we're looking to add this substantially. So I do not see a challenge in the deposit growth. Yes, there's a fight. Answer is yes. It's more to do with cost. At any cost, at any rate, deposits are available in the market. Like I mentioned earlier, the focus would be and the thrust would be more on CASA piece and deposits, maintaining and ensuring the cost aspect of it.
When I look at banks, the banks have a very strong growth in the unsecured category. That's Federal Bank or HDFC Bank or SBI. But if I look at the real data, which is on-ground data, rural demand, two-wheeler sales, property prices, there is evidence of a slowdown. So the question which perhaps I'm asking every banker is that are they taking undue risk when it comes to the unsecured loans? Because the real economy, which is the rural economy, the bottom of the pyramid category, that is not exhibiting growth. Yet the unsecured category for every banker is going. Is this a risk which could haunt us, or you think it is manageable?
The risks, very frankly, is manageable. If you look at Federal Bank, I'll talk about the industry and then I'll talk about the bank in particular. Yes, there has been concerns raised and there's been a lot of media coverage about unsecured piece gaining share and will that become unmanageable? I don't think so. At the system level, we are facing any risks. Are there concerns? Does this need to be monitored? Answer is very clearly yes. If you look at Federal Bank, I think our share in the unsecured piece has been relatively lower than some of our banking peers. And we're upping it. We're very clear about doing this part in a very calibrated manner, covering and the risk. The one part which is a little different from earlier, today you have the bureau data available. And most of the customers I have come across, even the retail or the corporate side, they're very conscious of the fact that the delayed repayments will actually mess up their credit score and hence are very particular about doing that part. So that is one. Secondly, there's so much of data available and so much of analytics, which enables us in terms of predictive analysis of what the repayment patterns would be, is far more easier today than it was earlier. So these things are definitely helping us. Third piece, when you're talking about the rural, I'll just add one thing over there. We do the microfinance piece. We have just about crossed 2,000 crores in terms of our microfinance portfolio. We were at about 450 odd crores in March 22. And we've been going at a reasonably rapid pace, partly because of our low base also. Our experience over there has been quite good. And if you look at the microfinance industry in general, the slippages are extremely low. These people are not somebody who would want to default. And they are by nature people who would like to abide by and pay on time. Yes, there could be nature-related or external factors which may impact the repayment capacity. But the intent is always there to pay. Our experience even on the microfinance piece has been reasonably good.
Thank you for taking time out and joining in, giving us a heads up on how financials are shaping up as well as an outlook on the overall metrics. So 18 to 20% growth is looking to be maintained. They will be focusing on increasing current accounts. And as of now, no challenges on the deposit growth. Fed FINA this financial year is when we can expect it. All right, what's the market up to? Holding out at 19,434. The broader markets yet again are showing you a lot of fervor. And within the small cap index, which by the way is up by about 1% in trade, there are a lot of names flying. Deepak Fertilizers, IRB, Sterlite Tech, Mastech, India Bulls Housings and Bharat Dynamics. But let's move right on then. And in our special segment of Market Makers, we spoke with Milind Karmakar on the spaces that he's looking to add into his portfolio. He discussed his outlook on railways, defense, IT and consumption. Listen in.
So yes, we have added, like last time also I told you, that we are looking at adding some industrials to the portfolio. So overall industrials in our portfolio have moved to about 15%. And they are into railways, they are into power ancillaries, which benefit out of the second generation power reforms. And of course, the others continue to, there is EMS players as well. Those are the new kids on the block. And I think there the opportunity for growth is also significant. So our basic theme remains same, that wherever there is growth, at least visible for next 5 to 10 years, go and invest in those companies.
Okay. Let's pick up railways.
Yeah.
It's a business where it's dependent on government capex.
Absolutely.
It's a business which is completely B2B business.
Yes.
and it's a business where you don't have the best margins.
Right.
Why do you like business? Because the typically places where you've invested in are companies with linear growth and businesses with fat margins.
So when it comes to railways specifically, I 100% agree with you that it's dependent on orders from the government. But there are companies in wagons where significant portion also comes from private sector. And what happens is that once the direct freight corridor is ready, then I do expect a lot of freight to move to railways from roads, and that is where I think the growth will come in. So it will not only be government orders, it will also be private sector orders, especially in wagons, which will drive the sector, especially the segment where, as far as wagons are concerned. As far as Vande Bharat is concerned, again, there is a large opportunity. But I think there, the issue will be that the first Vande Bharat from the private sector will roll only in 26. So one will have to wait for that time. But wagons is something where I think the growth will continue over the coming 2-3 years as well and beyond that.
So you don't think railway stocks or defense stocks right now have reached Humpty Dumpty level?
I don't think so, but at the same time, I think investing at this price, one needs to be cautious.
Okay. When you are increasing your exposure to railways and industrials, are you looking at booking profits somewhere? Because for one stock to get in, one stock has to come out.
Yeah. So we have been moving out of technology. We continue to do that. We trimmed some exposure to our consumption stocks, not because we wanted to, we thought that they were fully priced, but more so because the weightage of some of these stocks went up very high. So that is the reason why we trimmed. And of course, we got out of some of our losses as well, and then moved that money into industrials.
Where did you get out of completely? Where did your investment thesis got challenged?
So in technology, there were 1 or 2 companies where we got out.
That's a call on the cycle or a call on price?
It was a call on, frankly, it was a mistake where we got into at the wrong time, and the stock price simply fell. Okay. So that was one of the reasons why we got out of some of our, or rather one position in technology. We also got out of some real estate stocks where we made money. So because real estate, our view was that it was not in a multi-year bull run. So that is the reason why we got out of that. And as I said, 1 or 2 of our retail stocks, we sold something because the weightage was very high. That's all.
Okay. I'll get into specifics of technology, but I will spend some time understanding a holding which has done very well for you, and that's Trent.
Yeah.
The stock is at a multi-year high.
Yeah.
The stock is now trading at a P multiple of 100 plus.
More than that.
More than 100 plus. Okay. What's the P multiple?
I think it's about, I mean, trailing basis, it would be at about 160.
Okay, 160. History tells us, and it's a global data, that if you're buying stocks at P multiple, even if you're holding stocks at P multiples of 100 plus, the future return for next 3 years is always negative. How would you justify holding Trent at these levels?
So I do believe that if I look at the past 3 years, I think they will continue to grow at anywhere between 30 to 35% year on year, especially because of their growth which they are seeing in Zudio. And I do agree that there are a lot of players who are getting into affordable fashion, but at the same time, I think they have a first mover.
Okay, that's none other than Milind Karmarkar highlighting where consumption as a theme may be headed. But talking about consumption, how can you not talk about passenger vehicles, right? And who better than Shashank Srivastava from Maruti Suzuki India himself to highlight what's going on with the company and the sector overall as well. Shashank, great to have you on ET Now once again. Welcome back. And, you know, industry channel checks have been indicating that in the month of August, the passenger vehicle demand was actually up 9% and Maruti sales were higher than the industries. What's been your analysis, whether this is a trend which is here to stay?
So far, you know, this year has gone very well for the auto industry. So we have seen a record April, the highest ever April, the highest ever May, highest ever June, highest ever July. Looks like the highest ever August. In fact, August numbers in the industry predicted to be just around the 355,000 mark. which could make it the highest ever month also. Last was September 2022, which was 3,55,400 odd vehicles. So yes, it's been a great run so far. And now we are into the festive season, the beginning in Onam festival in Kerala. That's where the festive season starts. Has been pretty good, almost a 25% jump in retails. So I think so far going is good. We have those couple of question marks though going forward. But yes, it's been good so far for the auto industry this year.
I was reading in one of the pink papers that the sedan inventory levels are at a 4-month high. So while the aggregate picture because of SUV may look strong, SUVs are selling and sedans are not selling. So is that a concern that one end of the market is doing well, other end is not doing well, and if sedans are not selling, there could be a discounting, discounting factor at play in the run-up to the festival season?
Yeah, so you're right. Actually, in some ways, you have, I keep saying, a tale of two cities. So we have certain models which have got excess inventory, sometimes going up to 50 days of stock as well. And there are others where you still have pending bookings. In other words, there is a waiting for those models and therefore very low inventory. Clearly, however, since July, we have seen a uptick in production in even those models which were earlier in short supply, thanks to the better availability of semiconductor related components. And that's the reason why the waiting periods would have been coming down last two 1.5 months in even those other models. Inventory, as you mentioned, is high, and it's not a 4-month high, it's a 4-year high. And of course, the last couple of years have been pretty tight as far as inventory is concerned due to various reasons. COVID lockdown, you had supply chain disruption, semiconductor crisis, and so on and so forth. But yes, the last time we saw this level of inventory of almost 300,000 in the industry was in September 2019. So that's really a 4-year high. But expectedly, because people are preparing for a large retails in the upcoming festive season. So I think that's a normal phenomena where inventory is built up in the channels.
Yeah. Okay, thank you for clarifying on that. My immediate follow-up question is that, so can we ignore this inventory built up? Because what you're telling us that, look, this is inventory built up which could be a precursor to the dealers expecting strong sales. This is not because sedans are not selling and that is the reason why inventory levels are going higher. It's nothing to do with drop in demand.
Yeah. So as I said, the demand has been peak. We would probably see the highest ever August, and in fact the highest ever any month sale. It's possible. So clearly, in terms of volumes, this year has been a record. You can expect April-August figure to actually cross 1.7 million. It's only the first time ever. So in terms of absolute volume, sales have been pretty good. But therefore, in terms of inventory, yes, because we have the channel has got used to a lower inventory, even at inventories of 300,000 with actual retails of averaging around 325,000 a month is still less than 1 month of inventory. So even though in absolute terms, the inventory is high and 4-year high, but in terms of the number of days of inventory, it's certainly not so high. So yes, a short answer to your question is, yes, inventory is high, but it isn't because sales is slowing down.
Again, you'll appreciate the spirit of my question. When we talk about inventory, the next question which television anchors, they ask the management is that, are you looking at a production cut? So I'm assuming that there is no production cut, right?
Yeah, no, absolutely. In fact, July production for us was very, very high. So is August. We just got over. In fact, we have pending bookings of almost 340,000 vehicles. So there is production cut. It is possible, though, by the way, that production you may modulate basis the inventory level of some models. So, but the overall numbers certainly are showing an uptick as far as production and sales is concerned.
Delve a little bit deeper. What we would really want to understand is what's lying in the inventory. Is it the newer models or is it the older ones?
No, it's not the newer models in the sense it's not those, and expectedly so, because you have pending bookings for some of those models. For us, like for example, the Grand Vitara, the XL6, the Brezza, the Jimny, the Invicto, the francs. These are Artiga. These are models where we have large pending booking. So obviously stocks is not there for. More stock is available in the other models. I wouldn't classify as old versus new, but more as the vehicles for which production was less earlier and now it is getting better, versus vehicles for which production was higher earlier, and that is why the inventory buildup happened in those models.
So how do you tackle a situation like this?
Yes. Yeah. Did you ask a question?
Yes, that was the question.
Yeah.
Yes.
I didn't get that. Yeah.
No, I just wanted to understand, like, I mean, how do you tackle a problem like this? What's the solution?
So it's fairly simple in that sense. You look at the inventory levels, and wherever the inventory levels, you fix a inventory level in the network and in the factory. And if you feel that that has crossed that particular level, you modulate your production. It's not as if you have to bring down the production of all models or increase the production of all models, because you have different lines and different plants having production of different models. You can always modulate that. And that's what actually has been happening. But the problem in the last year had been that we could not produce because of semiconductor short for some of the models. So necessarily you have to produce the other models, which may be even more, you may be producing more than what the demand was. And that had created the situation which we are finding today, a higher inventory in some models and absolutely very low inventory in the others. It is not, and I think that's what I mentioned earlier also, we need to look out for some factors which can impact negatively going forward. And there are some factors which we are watching very closely though.
Okay, and what's the outlook then when it comes to the PLI auto scheme? Because I understand that the committee has called for industry feedback. Have there been any issues, any difficulties that OEM, component companies are facing? What do you think would be one of the key discussion points here?
So the PLI scheme actually is encouraging, investment in areas for localization in technologies which are going to be in play in the near future. It's a very good scheme because it sort of gives the incentive to for production of those technology or to test those technologies. But yes, there would be obviously issues. And our industry body is in discussion with the government, as you rightly pointed out.
Just wanted to get in an outlook from you as well as to what the outlook is in terms of your take on the SUV space.
So SUV has been growing. It has grown from roughly 26% 4 years back to now almost 49% last month. So cumulatively this year, it is 47% of the industry. Expected to grow even further coming years, expected to plateau around the 52-53% mark. So it's going, is now the largest segment of the overall market. So yes, the SUV numbers are good. It is getting more competitive though, because you have now almost 47, 48 models competing in this space. We have launched many SUVs, as you would have observed. And one of the weak points which Maruti had was that our share in the SUV market was low. We were actually number 4 or number 5 manufacturer in terms of SUV sales. But with the introduction of these new models, we have seen, with our calculation, and now we have seen that in July, we became the number 1 SUV manufacturer. And that was one of our coveted objectives, which we had said at the beginning of the year. So we are hoping that that run will continue for our SUVs in this balanced part of the year as well.
That trend, Shashank, last but one question, of SUV sales commanding 50% plus market share, sedan sales dropping. Do you think this will only multiply more? Which is that, I mean, I never thought 3 years ago SUV will even be close to 30%, but the numbers are today's 50 plus. Do you think that 50 could become 60? Could it become 65?
So I just mentioned that our calculations show it should plateau around the 53-54% mark. But what has happened, it has come in earlier than what we had thought. So, but our projection basis research done in similar circumstances in other countries, it generally plateaus around the 53-55% range, and that's what we are expecting in in this. And regarding sedan, yes, sedan has been falling. Remember, sedan percentage of the overall industry was about 24% at its peak about 7 years back. It's been consistently falling down. It has come down to less than 10% now in the industry, and that's a pretty steep fall. And more worryingly, the fall has been in the mid sedan and the upper sedan segments. The sedan segment, if you say 10%, 9.5% is sedan, out of which 7% is entry sedan, which has remained quite strong. So out of a 4 lakh sale last year in sedan, 3 lakh plus was entry sedan. That has remained a little consistent, but the mid sedan and the upper sedans have fallen dramatically. And that is one of the reasons why most OEMs are not focusing on the sedan segment, looking either at the entry sedan or at the SUV space.
Festival season is about to start. It's going to be Janmashtami followed by Ganpati, then it's going to be Diwali, Dashera, Onam yesterday. Festival season has started. Are buyers in for a discount? Do you think this time around discount, which have not been there from last 2 years because of first COVID and then because of demand and supply equation, this year discounts could make a comeback?
Yes, so discounts sort of have made a comeback already in some models. And you are right, last 2 years, we haven't seen discount across any model because all models were in short supply. But as we discussed earlier part of our conversation today, there are some models where you have excess inventory and excess supply, and those are the models where you will see discount. However, I don't see them going up so there is already some high level which won't go up because earlier the discounts have come even prior to the festive season because of that production mismatch that we talked about. And now that the production mismatch can be modulated because of better semiconductor availability, I would expect discounts not to rise from the current levels.
Sean, great to have you on the show. Thank you so much for taking the time out and speaking with us.
Thank you.
Right, let's move on. Let's just revisit what the market is up to. We've settled in nicely, actually. After many days of a very quiet move, you finally picked up steam and a good 0.5% at that. BHL, look at that stock. Once again, 3.5% of an up move. Amongst the large caps, it's Tata Steel, M&M, Axis, which are leading the charts. On that note, we're going to take a very quick break. Come right back. Lots lined up on the other side.